I gave ChatGPT the following request. These are my 21 holdings from a 28,000 dividend stock portfolio. Can you analyze the advantages, risk, and what improvements can be made? This is in order to see how artificial intelligence view my portfolio and see a different perspective from a source that is not a human being. I will be going through the response to find out if I agree or disagree, and maybe we can learn something new. Who knows? Let's dive in. This is a 21 holding dividend stock portfolio valued at $28,000. It's diversified across several sectors that brings an approach of growth and stability. From top to bottom, the diversification goes as the following. Tech is 38%, consumer defensive is 21%, healthcare is 8%, financial is 6%, consumer cyclical 11%, industrial 3%, and real estate 4%. This look accurate, so ChatGPT already started correct with the sector allocation. Now, let's take a look at the advantages. 1. Strong blue chip focus. You're holding high quality, proven dividend payers. Apple, JP Morgan, Microsoft, Procter & Gamble, Johnson & Johnson, etc. All are large cap, stable, and shareholder friendly companies. Number 2, well-rounded defensive core. Consumer defensive plus healthcare gives you a 30% in stable sector, helping reduce volatility in bear markets. Stocks like Procter & Gamble, Colgate, Johnson & Johnson, and Kroger protects against economic downturn. Number 3, tech exposure with strong dividend growth. Apple, Microsoft, Texas Instruments, Automatic Data Processing, MasterCard, Visa offers a strong dividend growth, not just yield. These are low payout ratio, high return on equity companies, ideal for long-term compounding. Number 4, low redundancy across holdings. Most stocks offer unique sector or strategy exposure, reducing overlap. Example, MasterCard Visa handle payments. Texas Instrument makes semiconductors. ADP focuses on payroll tech. S&P Global is a financial information company. So, I agree with the advantages that ChatGPT provided. I focus on a combination of high-quality businesses that offer market-beating returns on one hand, and on the other hand, the stability to withstand volatility. All my companies are shareholder-friendly, meaning that they return money back to the shareholder in the form of dividends or buybacks. Now, let's take a look at the portfolio risk. Number 1, heavy concentration in tech, 38%. While your tech exposure includes quality names, nearly 40% is a lot. Tech is more volatile, especially in rate hike or macro shock environments. Many tech firms offer lower yields than other sectors. Number 2, underweight in energy, utilities, and industrials. Zero exposure to energy like ExxonMobil, Chevron, which brings inflation protection. Utilities, stable, regulated businesses with constant yield like Duke Energy. Materials and telecom often offer yield diversification like AT&T and Verizon. Number 3, realty income equals risk in rate environment. Allocated at 4.51%, which is a decent size for a single REIT. Realty income has struggled with rising interest rates, and the risk capital loss outweigh dividend income. Number 4, overweight in lower growth defensive stocks like Colgate, Procter & Gamble, Pepsi, and Hershey's can underperform in rising rate or growth focused markets. These stocks rely on margin resilience and pricing power. Okay, so for the risk, there's several things to unpack here. Yes, the portfolio has a heavy concentration in tech. The same premise will apply to the S&P 500. Tech is here to stay, and most companies in the tech sector have the capability to do multiple expansion pretty quickly and grow the market cap of their business fast. When the year started, I wanted to increase my allocation in high quality companies that could take my portfolio to new heights. Those companies are in tech. I agree that the portfolio is tech heavy, but it's not a concern to me. For number 2, underweight in energy, utilities, and industrial, I'll disagree with this one. You don't need to participate in every sector to have a great portfolio. Some sectors are just not scalable enough, slow growth, and little to no innovation. So I really do not need that exposure when the portfolio is already sector diversified regardless. The other risk is for realty income. This is the only risk specific to a stock. So realty income is slightly a large holding in my portfolio, which is 4.5%, around 22 shares. Realty income underperforms in the high interest environment, which is the current circumstances. So it makes the capital loss to outweigh the slowing dividend growth and income. All of this is true. However, number one, I'm not adding more to my realty income position. Number two, high interest rates are not forever, meaning that when the rates go down, REIT's profitability will go up. Now, going back, that realty is 4.5% of the portfolio and I have 22 shares. If it goes up in value, that allocation will rise dramatically. So the information is accurate, but I don't see it as a risk other than being overweight in realty income. Talking about overweight, the last risk is overweight in lower growth defensive stocks. I 100% agree with this one. I went too heavy with these blue chip companies with minimal growth, and that hinders my portfolio to reach new heights. When 2025 started, I decided to go heavier on more high quality compounders, which are companies that are still growing fast, strong mode, and scalable with the current market. So far, that has worked, and year to date, I'm still following that plan, slowly reducing my defensive stance in the portfolio. Now that we look at the advantages and risk of the portfolio, we have to see what ChatGPT is giving me as an improvement plan to maximize my portfolio. Let's take a look at the options. Number one, reduce tech from 39% to 30%. You don't have to sell completely, but trimming Google, MasterCard, or S&P Global by 1 or 2% each. Reinvest into sectors you're underweight in. My answer is that no, I am not going to do that. These companies mentioned are core holdings on my portfolio that are still growing at a very fast pace year over year. I am not going to sell them to fund other underperforming sectors. There's very few companies, if any, outside of tech that brings fantastic returns, but I'm not sure if they can beat the companies I already own. So again, I'm leaving tech as it is. Number two, add to healthcare. Add a high growth or stable dividend name, United Health Group, Eli Lilly, or Medtronic, to round out Johnson & Johnson and AbbVie. Again, no. Keeping my allocation small and concentrated in healthcare is a smart move for me. Healthcare by nature poses a lot of risk with lawsuits, so there's no need to increase the risk of my portfolio. Just grab the best of the best and keep it concentrated. Number three, add energy and utilities. Add 1 or 2 names from ExxonMobil, Chevron, Duke, SO, and EE. Allocate 5 to 8% across these 2 sectors. I'll disagree with this one as well. Beside the circle of competence, my portfolio is sitting at a combination of growth and stability. Adding to slow growth sectors will slow my market beating performance. Number 2, add a second industrial. Waste management is great, but you should add Union Pacific or Honeywell for infrastructure and logistic income growth. Well, my answer is that waste management is enough with their subscription-like business model, so I really don't think I need to add another industrial. Number 5, use tiers to guide rebalancing. So we have a combination here about core holdings, hold steady holdings, holdings under review, and so on. The thing is, I already do that, but with a different approach. I have made several videos about doing a tier list of my portfolio where I classify them from being the best, which are S tier, to the weakest, which is D tier. I do call a certain group of my holdings core holdings. Overall, I feel that despite analyzing the information, ChatGPT response to my portfolio feels below average. I expected a more detailed explanation of why I should do certain changes. I believe for next time maybe I'll need to be more specific with the prompt so I can get the detailed response I'm looking for. The current strategy and how my portfolio is operating is working year to date. So if it's not broken, why fix it? Let me know if you guys agree with the response ChatGPT gave, or if you have a different take that you think I should look for. That will be it for this video. Thanks for watching, and I'll see you in the next one.